Welcome back, my awesome people. Today, I am honored to be joined with Eric Pachman. If you have not heard of him, he is the Chief Analytics Officer from Bancreek Capital Advisors. Now, Bancreek uses a much different strategy than what we've had on this channel. It's not options, it's not covered calls, it is long-term investing, but with some special technology and strategies. So please stay tuned till the end because Eric Pachman is full of knowledge. We're going to be looking at healthcare, inflation, CPI, tariffs, of course, global economics, even the local economics. So we're going to be covering a lot in this episode. So stick with us, and I'm sure you will definitely benefit. Eric, thank you so much for joining me today. I know it's a totally a busy time. How are you doing today?
Oh, I'm doing fantastic, Jacob. Thank you for having me on. I'm very excited for this talk.
Well, I am so happy that you're here with me, and I'm happy that you're excited because you are a person full of knowledge, and this is something that I love and that my viewers will love. So, before we waste any more time, let's get right into it. So, Eric, before we dive into Bancreek's ETFs or ETFs as a whole, can you tell us about how you got into finance? Maybe provide us an overview of Bancreek's history and how you ended up at Bancreek, and some of your
Yeah,
expertise as well.
yeah, I'd love to do it. So my best friend and partner, Andrew Skadoff, who's CEO and Chief Investment Officer, he always says when I go into my story and my background that it's kind of like Forrest Gump. So you just keep have that in the back of your mind. And by the way, I love to run too. So Forrest Gump is kind of, that's aspirational. So I'm a chemical engineer originally, graduated in 2001 from the University of Florida. I started working in oil and gas, doing a bunch of simulations and modeling for refineries at ExxonMobil. Spent about 4 or 5 years doing that. And then they moved me over to the upstream side of the business where we're actually like extracting oil from the ground, right? And I got a chance to work on and build operator training simulators for platforms off the coast of Nigeria. So, I'm happy to talk about oil and gas as well in my experience there. But when I went over to Nigeria, I had the chance to spend 3 weeks there. What's going on over there is obviously they want the oil because you can transport the oil, but associated gas comes out with oil, right? And so what do you do with that when you don't have a local economy and you can't easily transport that? I mean, you can turn to LNG, very expensive projects to do that, right? So in what they do with it in Nigeria, at least back in the 2000s, I'm sure they still do it, is they send it to a giant ground flare, which looks like a fireball coming out of the ground. Which, like, don't quote me on this, but I was told that it can power the entire state of California with how much gas that's burnt there. So Exxon had this wonderful idea, which this truly was that, we're going to take the gas and we're going to re-inject it back into the wells in order to increase the pressure of the wells, which then can help increase oil production within those wells. And so it was a multi-billion-dollar project, and we built the simulators to so the people that were training to operate that could deal with shutdown scenarios, stuff like that. Anyway, I'm fascinated by that, so I spent a little more time on that. So I hope you don't mind. um, Eventually, I left that, went to business school. I decided to apply to some of the top business schools. I'm like, if they let a state school guy like me in, I'll go. And so I got into Harvard. I'm like, I don't know what I'll do, but I'm going to go to Harvard. 2 years out, nobody wanted to go to be a sell side research analyst, and so I'm like, fine, I'll go do that. And they brought me over to Morgan Stanley, and I was, the guy behind the analyst that you see on CNBC and everything. That was basically building all of the long-term financial models, DCF models, all that kind of stuff, and then writing a lot of the research that was published by Morgan Stanley. So I spent about a year and a half doing that before I went over to work for a family fund in New York. So larger families that have their own investment teams. I worked for one of them as a senior analyst, and I was specifically focused on commodities and specifically commodity linked equities. So, find iron ore miners and copper miners and ag companies and oil and gas and all sorts of companies all over the world. And so I spent most of my time doing that and then flying all over to kind of visit these companies. Eventually made a life change and moved down to Florida. Wanted to get closer to my family at the time, which will become clear why in a couple minutes. And I literally went back to the drawing board. We weren't liking New York and moved to Jacksonville and started working for CSX, which your listeners may know, is one of the two Class 1 railroads east of the Mississippi. CSX and Norfolk Southern are a duopoly. They've kind of divided up the territory, and spent about 5 years working many different jobs within the railroad, supporting the CFO. I became the assistant chief engineer, and I had responsibility for a multi-billion-dollar capital budget. So where should we be investing all of our money in order to maintain the railroad, all this stuff. Anyway, long story short, I eventually got a call from a friend who said, "How would you like to come run some pharmacies?" This is where the Forrest Gump analogy really comes in. "How would you like to come run some pharmacies in Dayton, Ohio?" Which, of course, makes a lot of sense given my background up until then, but it was a guy I knew from Harvard. And my wife had very strong, like I'm talking about half a century ties to the Dayton, Ohio area. And so, like, it could have been anything. It's like, how would you like to work at a pizza shop in Dayton, Ohio? I would have done it, you know? And so I got to bring my wife and my family to Dayton, Ohio to raise my kids. I'm still there. We love Dayton. Um, but I ended up working for a pharmacy chain, a struggling independent pharmacy chain. So these are the mom and pop pharmacies, about 20,000 of them across the country that are largely going away. I knew nothing about pharmacy. I knew nothing about healthcare, but came in 2016, pretty much at the exact time that I was able to see through all of our data, because I was a data analyst at that point in time, an operations guy. I was able to see really what's going on behind the scenes within the healthcare space, and got a unique view from, looking at the data of the pharmacy into something that I'm sure we'll talk about a little bit later, but what's called spread pricing. So it's the gap between, in the US, what a pharmacy benefit manager will charge a client, say an employer, and pay the pharmacy. And in some cases, on the same claim, it could be $1,000, it could be $2,000, it could be $5,000. And the pharmacy is the contracts with the pharmacy is completely hidden from the contracts with the client, so neither of them know that they exist. I'm watching Severance right now. It's kind of like that, right? So if you've ever seen the show on Apple TV, it's like the innie and the outie, the work life and the personal. They don't
Yep.
know each other exist. That's what the PBM is doing. The PBM is kind of like Lumon, within that show. So anyway, I got to see that from behind the scenes. I'm trying to turn around these pharmacies, trying to do all the operational stuff, dealing with personnel issues, everything. But then at the same time, seeing this kind of like life or death situation that's confronting pharmacy with not being able to control their reimbursements at all. And there was no recourse, right? So I'm trying to figure out, like, who do I tell about this? Because, like, literally the PBM can magically overnight change the price that we get paid for our drugs. It's nothing to do with the cost of the drug that we acquired at, right? And so I ended up spending a lot of my time in Columbus, Ohio, which is where the capital is, and just literally meeting in Starbucks, showing people data on screens, being like, here's the gap between what the state is paying in Medicaid and what pharmacies are receiving. And it didn't matter. GOP, Democrats, didn't matter. They were all like, oh my gosh, how come we don't know about this? And so a couple of years passed of these kind of, secret meetings because I'm not technically not allowed to share this pharmacy data, so I can't do this publicly. And eventually I figure out, oh my gosh, CMS, so the Center for Medicare and Medicaid Services, actually has a lot of this data for Medicaid online in the public domain. I just didn't know how to work with that data, so I play around with it, in Tableau, doing data visualizations, and I figure out how to connect that with the actual cost of the data. Now I have a public data set that I can share. And by the way, the experience in the public data set lined up exactly with the messed up experience within my own pharmacy claim. So I was able to validate it. And then we went to the press because we weren't making any progress within the state. And the Columbus Dispatch published, I mean, over several years, they ended up publishing almost 90 articles about this. They had national recognition for the PBM manipulation of pricing, all the different contract games that they play. And that really was the beginning of the end of spread pricing, not only in Ohio, but across the entire country. I mean, ever
Wow.
since then, I think it's something like 20 states have abandoned it within their programs. Of course, PBMs have just figured out a different way to kind of like label it, and it's not spread pricing, it's something
Yeah.
else. Like, it's a game of whack-a-mole. But there's been some actual real reform that kind of came out of that work. I ended up leaving the pharmacy because I couldn't do all of this work. It was a conflict. And so I left it and I formed a nonprofit, 46 Brooklyn, And then I also formed a for-profit because I didn't get paid anything from nonprofit that worked with pharmacy groups, worked with lawyers, and so on and so forth to do custom bespoke data analytics work specifically for understanding how money flows through the prescription drug supply chain. And we didn't have any competition. We were pretty much the only company that was doing that. And we got a ton of press. I mean, there was a huge, I mean, as you know, like there's a lot of attention on healthcare right now. And it's been that way because people's experience of it is very, very frustrating. And they're like, this is so complex. Can't anyone explain it to us? And so we really were trying to do that. Anyway, another Forrest Gumpy part of the story is that at one point in time in 46 Brooklyn, I'm a nerd. So I put up like a 30-minute tutorial on here's how you build the data visualizations that I've made free to the public. And I'm like literally like put this here, put this here, put this here, pivot the data that way. It was the most boring thing ever. I didn't know any better. But you know who actually likes it and reposts it? Mark Cuban. And so it ended up becoming our like number one liked and like most popular post ever because of course Mark Cuban did it. Anyway, we start DMing him. He ends up being a big fan of our work. I end up doing some projects for him. I mean, we can talk about him more later, but I mean, he's a fascinating individual, just a wonderful human being, and really, really thrilled with like the work that he's doing in order to really use his brand in order to like massively disrupt like everything that's going on within prescription drug pricing because everybody knows how to do it, but you need to have like the Mark Cuban brand in order to do it. Nobody else has been able to figure out how to do it, how to kind of supplant the incumbents, right? So that was like a whole nother like aside there. But anyway, so I'm going down this like crazy path with that. And then I start looking into like international drug pricing. I know you're from Canada. I'm doing analysis on Canadian drug prices. I'm doing analysis on Australia and everything. And I'm like, oh my God, every other developed country has figured out this except us. And so like I had always thought we have a problem that it's like, well, there's no solution to our drug pricing problem, our healthcare problem. But we just decided to build it a totally different way. And the way that I like to say is like, we are a country of businesses that has people that work for the businesses. That's our business model, right? I mean, like, look, there's nothing wrong with it inherently, but we put businesses first and we put people second, right?
And also
Whereas,
innovation, right? Like you may not put innovation first if you put business first as well, because we can just stay on this topic for a bit longer.
yeah.
But what did the Canadians and Australian system have that the American one didn't? What were the differences?
So we did an apples to apples. I dug deeper into Australia's data because it was easier to use. And we did an apples to apples comparison of like a mix of drugs that a country would consume, you know. And Australia's prices on brand name drugs, so those are the drugs that are under patent still, was on average 85% lower than the US on list price. That's different, right? And so now when Trump starts talking about, anchoring our prices to the most favored nation, that's the opportunity that he's starting to talk about. Now, there are a lot of issues with this. The execution of it is messed up. Innovation would basically go up in smoke. We wouldn't get any new drugs. Like, so there's a lot of problems with it because the offset of that is that we will bring like a brand new cancer treatment, right, to market. We'll bring a brand new Alzheimer's treatment to market. Those are all being subsidized by the US market, right? The way that our market works, there's so much profit available because of the way it works in the US market that we basically are subsidizing drug development for the rest of the world. But we get the drugs first. So like if you want that brand new Alzheimer's treatment, it probably will be covered under Medicare. And then about 4 years later, Australia will get it. And so if you're in Australia over those first 4 years, you're SOL, right? I mean, you can't get it. And so that's the price that you have to pay. Like my one of my good friends and I, who's like an expert more so than I am on this, we always talk about it. It's like, what do you want drug pricing policy to do? You know, do you want it to innovate? Because arguably we have one of the best systems to innovate, but it's like hugely inefficient and people are profiteering off of it, price discrimination everywhere, but it innovates, right? I mean, where did the best COVID vaccines come from and how fast did that happen, right? Or do you want it to be accessible to everyone? Do you want it to be affordable? You can't have your cake and eat it too. You just have to decide, like, what do you want to prioritize over the other thing? Canada has decided what they want to prioritize. Australia has decided what they want to prioritize. They want very affordable drugs for 98% of the people and the conditions that they have to treat. and they don't want anyone to pay more than $30, $35 AUD, which you don't have to within Australia. So it's not going to bankrupt you there. Whereas we've just let the system decide what it wants to prioritize, and it ends up prioritizing innovation. And then we have the side effect of profiteering and people rationing in insulin and
And
people
has this
healthcare.
system been around since the beginning of the pharmaceutical industry, or is this something that kind of recently, maybe 15, 20 years, just started appearing?
It's been like brick upon brick upon brick upon brick, rotted brick upon rotted brick of building this over many, many, many years. And there have been like step changes in it, right? So, I mean, and I'm not a historian on this, or not the best historian, but clearly when Medicare Part D came into play, which is the prescription drug coverage for Medicare, that was a huge step change. But then what the federal government has done is they've basically said, we want people to have healthcare coverage, right? I mean, there are 100 million people on Medicaid right now. Think about that. Like a third of the country is on Medicaid. That's low for low income, right? And so we want them to have like access, but there was never any kind of rules or regulations. It was just like, let's let the free market determine how that access works. But the problem was the free market kind of became like crony capitalism over time, right? It was like,
It
okay, yeah,
became bigger.
we have these PBMs that are competing, but now the PBM acquires this company, and now it owns the pharmacy, and now it owns the healthcare company, and now they can basically just shuffle all the money around. And you end up with like when you look at Medicare Part D, so again, that's the 65 million elderly people have Medicare Part D senior coverage for prescription drugs. I don't know how many are in Part D, but 65 million people in Medicare altogether. And when you look at the inefficiency in the program, I mean, it's just kind of all throughout. I actually kind of forgot where I was going with that part. So
No
you
problem. So what my next point was, no,
know.
because what you were trying to prove was the difference in systems between the American and the Canadian and Australian. But then what I wanted to mention was, what is the role of the FDA in this?
Ah,
I know they don't, make the prices. However, I'm sure they have some type. I'm sure they kind of know what's going on.
yeah. So I love that question, and I mean, it really tells. So I'm not just trying to compliment you here, but very few people ask that question, so I really appreciate it, Jacob. Um, so let me contrast this with Australia, right? So here, the FDA has two mandates. The drug to get approved has to be effective and it has to be safe, right? That's it. It does not have to be efficient. So in Australia, the drug has to be safe and effective. And then the PBM function. So there is a part of the government called the PBS, the Pharmaceutical Benefit Scheme, that makes the determination, is this drug efficient? So, for example, there are drugs that are called combo drugs, where it's like if you and I, Jacob, are a manufacturer and like, man, we're out of ideas. Like, what drugs do we bring to market in order to like make a bunch of money? Well, in the US, what we can do is we can take two ancient generic drugs that have been around for years and years and years, and so if like you or I had to take two different pills, we can combine them into one, and then we can mark that up by like 10,000%. And then bring that as a new novel therapy to the US market, and it will find a home. Like, I mean, there will actually be coverage for it, whether it's in commercial plans or whatever. And then you or I can offer massive rebates to the PBMs in order to prefer it on different clients' formularies and all sorts of stuff. There are games that we can play in order to get it in. If we try to go to Australia, they'll be like, yeah, we're not buying that from you. Like you want to charge us $5,000 for it? Like we'll pay 25 cents because that's what it costs for the other two combined. So this country has philosophically decided that it wants to hand the reins of deciding which drugs are effective or efficient, like which drugs should be on the formularies allowed, for employers, for patients, or whatever. It has handed that over to the private market, which has warped its function over many and many, many, many years and is not doing that anymore because its economic incentives aren't aligned with actually doing it. It's aligned with choosing the best drugs that are going to make it the most profit. I actually ran into Scott Gottlieb when I was in my prior function before Bancreek. And this was after I did a 70-page report on the drug Nexium. So literally 70 pages on one drug. And it's the entire history and story of this one drug, which is literally no different. I mean, the drug at the time, I think it had like netted $60 billion in revenue globally or something like that. And it is a drug that should have never existed because it's what's called an S enantiomer of another drug that was an old, cheap, mature generic called Prilosec, which I'm sure a lot of people who have any stomach issues have taken either Prilosec or Nexium, both available over the counter now. But the company AstraZeneca had basically said, oh, look, we're losing our patent on this one molecule, which is called the omeprazole molecule. We have no other ideas with how to fill that gap. Our revenue is going to decline. We don't have any novel therapies that are in the pipeline that are going to come out at the right time. And so let's bring to market the mirror image. So it's literally right hand, left hand, mirror image molecule called esomeprazole, which they basically branded as Nexium. They sold it as the better purple pill, blah, 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 blah. One thing led to another. Read my report. It's available for free on 3axis.com. And it ended up netting $60 billion. So that's the difference between the US and Australia. Australia would have basically said, we don't need Nexium, we got Prilosec. Why would we ever bring that to market? It makes no sense.
I guess that's
Anyway,
the capitalistic society, right? The go-getting of profits. I mean, it's kind of like green apples and red apples. It's like the red apple, you've used it for so many years. It's kind of getting, out of trend and you're losing money on it. Then you're like, hey, I have a green apple. And there you go. It's the exact same nutrient
exactly.
content, the same exact micro, macro nutrients, but it's just maybe a different color, maybe just a slightly different taste. But how is that legal? Um, like for example, like I know there's patents. However, if I was a company waiting on that patent to expire, and then the company just makes a mirror image of the exact same drug, now I'm waiting even longer because the
Yep.
patent won't be released. So,
Yep.
is there anything like I know you said there's a reform that has been happening, but has anything actually in action been happening, or is it still happening?
No. I mean, I spent the better part of 4 years like pulling my hair out or my hair turning white, you know, with this level of energy, trying to explain this to people. And what you find, especially when you're trying to explain it to lawmakers, they tune out. They just are like, whoa, this is like so complex. Like there's absolutely no way that I could actually explain this
And
to
they're
a layman.
probably getting a few dollars under the table by some
Oh, they
pharmaceutical
all are. Oh
companies.
my
Yeah.
gosh. Yeah, I mean, so I've
Maybe
been
that's
on
why the bills are not changing.
well, real talk, I've been on the back end. Like part of my job when I was working for Three Axis, like I sat down with policymakers in DC, staffers. And let me tell you, like for whatever anyone wants to say about US government, like that's the politicians, right? Behind the politicians live staffers. And these staffers are some of the most brilliant people I've ever met, right? And so you're sitting down next to them. They understand the game. They understand how to push policy forward. They understand unintended consequences of policy. And I sat down with GOP staffers, I sat down with Democratic staffers, and we found drug pricing policy that actually would be, it's like almost like surgical precision. Like it's not going to fix the whole thing, but you have to do like a lot of these surgical precision things that nobody will understand. And then it will just slowly behind the scenes start to fix things over time, start to reduce a lot of the corruption within the system. And I basically got Republicans and Democrats to be super excited about policy. It got shoved into appropriations bills. And then all of a sudden, either the hospital lobby, the PBM lobby, the wholesalers lobby, the pharma lobby, it didn't matter. Like all of the lobbyists will descend and everything will get killed. Like, I
Those
mean,
lobbyists.
the lobbyists are, I mean, they run DC. At least, I mean, I can't speak to everything, but I can speak to the healthcare side. And the lobbyists up until right now, which like I don't know what's going on right now because like I would have literally said it's a zero probability what's happening right now could ever happen because of the power of the lobbyists and how much money is flushing through. But I mean, the policies that are being put out right now is like potentially death blow to like healthcare. And so maybe the lobbyists just need more money or need to do a better job. But like,
Yeah,
I'm
because
shocked.
I've
Yeah.
done quite a bit of research on healthcare, pharmaceutical industries. I've interviewed many doctors and biotech and other people in medicine, and I'm also surrounded, even in physical form, with nurses and doctors around me as well. And I always have these conversations. And the one thing, exactly as you said, right? You try to push for a positive, but there's all these other factors and elements that want a little piece of the pie, so they're not gonna let that pass, or they're not going to let that go through. Now, the saying that everybody knows is pharmaceuticals, or even the medicine world, they don't want you, they don't want to find a cure. They just want to keep you healthy enough so you continue using their drug. Is that something that I'm sure you see as well?
Yeah, I mean, like, look, so back in the day, I don't know how long ago, you got I mean, not you or me, but somebody gets heart disease at the age of 50. That was a death sentence, right? And so now, I mean, we have all of this innovation thanks to the US market largely, that is odds are is going to keep you alive from heart disease, in order for you to get cancer in another 20 years and then ring up about $1 million in healthcare bills or even more. And so like the quality of life has never been a focus, but I mean, I kind of look at it like all the healthcare equipment company, all the insurers, like everybody that feeds off of this, including the state and federal government off rebates, they get to double dip on us now, right? So, it's not like I've improved my health in any way. It's not like I'm prioritizing any preventative maintenance. It's not like I'm meeting with doctors who are telling me about my diet and about exercise and all those kind of things. It's like once you have the problem, the US system is very much like it's code based, right? So if I do a procedure to you, I get paid for that procedure, right? Dental practices are like that. Like no
Yeah.
dentist will get paid well if they're just cleaning your teeth. Like dentists don't make a lot of money off me because I've been very good at
They got to
flossing for
upsell you on that root canal.
exactly. That's how they make money, right? And so you get paid for procedures. And so like we always had this statement that we have a system in the US where the sick subsidize the healthy. Like if we don't have the incentives of the system is to create more sick people. And so yes, they want to cure you or they want to heal you from your heart disease, but then eventually, the idea is for you to get some other, very expensive treatment because they don't make any money if they cure you from your heart disease. You go out and start running 5 miles a day. You totally transform yourself, right? Then you're not, no one's profiting off you anymore,
Yeah,
right?
and also another thing too that I've keep hearing is that in medical school, nutrition and the alternative forms of medicine are probably just one course out of their whole medical school journey, and everything else is all about pills, antibiotics, and all of that instead of go jog, eat
Yeah.
healthier. Like a lot of doctors and medicine people don't really understand nutrition.
Yeah.
Is that also another, not ploy, but maybe a form of keeping the medicine world just into pill pushing instead of here's the alternatives?
It's just the incentives. I mean, like this is a natural fallout and outcome from the incentive structure of our system. No one gets paid to not sell you services or sell you products. No one gets paid to do that,
Yeah,
or
nobody does.
get paid very, very little. And then the other problem that we have, which I can't speak to Canada, but like, other developed countries, non-US, is that there's a lifetime owner of Jacob, your risk, right? So if the government owns your risk, it's in the government's best interest to keep you healthy because they don't want you getting cancer. They want to reduce the probability that you get cancer years and years down the road. Whereas right now, it's like every time, I mean, like for the people that are listening to this, like every time you switched employers or you go onto the marketplace or however you get your health insurance, like how many different insurers have you had in your lifetime? I've probably had like 5 or 6. And so that's a fundamental flaw within our strategy, right? Nobody cares about what's going to happen to you in the US 10, 15, 20 years from now, which also is a problem when we start talking about like, how are we ever going to get, I mean, we probably don't have to talk about this as a moot point now that with what Trump's doing, but like, if we ever start getting like gene editing, CRISPR, like any of these things that are curative but very expensive, like why would insurance ever cover them? Like I can't figure that out why they would ever cover them because it's going to cost them a fortune up front, And then more than likely, your risk is going to move on to someone else down the road in the commercial market. So it doesn't make any sense from a business standpoint to cover that.
Yeah, I always hear a lot of athletes, celebrities are going, places like Germany, Netherlands to get, stem cell or gene therapy or something of that nature in medicine. So what are your thoughts on RFK, Robert F. Kennedy Jr.? I know he's the man of the hour when it comes to the health department. He's done a lot of layoffs, or I guess firings, I should say, in the medical department. What are your thoughts on him? I know he wants to revolutionize everything, make America healthy again. What are your thoughts?
Let me see. How do I answer this question? Everything's been so politicized nowadays, and it's very unfortunate because like I want to be able to just freely express my views without being associated. Like I really don't associate with either party. But whatever, people will interpret it the way that they want. But yeah, I mean I get it. There are some parts of what he stands for that to me make a lot of sense, right? But as far as pointing out, like we probably shouldn't have some of these additives and chemicals, dyes, like so on and so forth within our foods. They're not in Europe. They shouldn't be here. Makes a lot of sense to me. Um, I have a different seat though now than I did a couple of years ago, where it's like, yeah, that makes sense. Like I also look at it and it's like, well, if you're getting rid of M&Ms or making them change their ingredients or whatever, what is that going to end up doing to consumer staples? What is that going to end up doing to an already stressed job market and everything? So it's like there's no you can't have your cake and eat it too with any of this stuff. Like there are going to be unintended consequences or ramifications from any of these changes. Um, look, I mean, say what you like. I don't know where people stand on the vaccine spectrum. We know where he stands. And I know I'm very grateful that I got a COVID vaccine, and I'm very, very terrified of what's going to happen when the next COVID comes up. If we have this mindset right now, right? It's kind of a scary thing to think about of being so wholly unprepared for that, and there being so much anti-vaccination kind of sentiment. So that's a little troubling, but I don't have like that strong of a view on like that he's bad or good or whatever when it comes to that. I think the layoffs are potentially reckless. Like I'm not saying that there is not a lot of waste within the government. There for sure is, right? There for sure opportunities for to make it more efficient. But I mean, the wholesale NIH funding cuts, they're there's one of a guy that I used to work with has done an assessment on this, and it's like something like over 50% of all drugs are in some way, shape, or form supported by the NIH. And so you look at it and you're like, one of the things that makes that America is so good at is innovation. Like you could say what you want about America, but we are amazing at innovation when it comes to just about anything, right? Because of how business friendly we are. And especially within healthcare, drugs, so on and so forth. And it concerns me a lot that we are basically chopping that off at the very early stages. And so overall, I think I'm concerned about all of that. I'm certainly concerned from like if people are investing within the healthcare space. Like I think that it's a whole new world that we're in right now. And I try to stay far away from healthcare. Like I used to have very strong views on the longevity of healthcare investments, I had a lot of conviction. I've dropped all of it because the changes have been so extreme that we're almost like we've pressed the reset button to a large extent. And so it's the amount of uncertainty that we have going forward.
I agree. Like I personally don't have any opinion on RFK. All I know is that he was a trailblazer during the COVID years, and he really hated Fauci. So as a Canadian, just watching it on the television, it's kind of like, two people just kind of bickering all the time. But I do believe that when it comes to healthcare, especially something that is so sensitive like medicine, there shouldn't be any drastic changes. Like if you want to change things, ease it in, because I think, as you said, right, 50% of drugs come from the NIH. So if you're kind of dismantling the NIH, then what's kind of going to happen to those 50 drugs, right? Prices can shoot
Yeah,
through the roof. It could be mismanaged, it could be
yeah,
sold off, whatever can happen. So I think you're absolutely correct that things in healthcare shouldn't just drastically change because it is such a sensitive and I guess, life or death kind of situation.
Yeah.
So let's take a little pivot and let's talk a little bit more about Bancreek's amazing strategy, because I was looking at the Bancreek website. I've looked at the ETFs, I read the strategies, and it really stood out that you use a lot of information theory and
Yeah.
also the NOTNA system, if I'm saying it right, NOTNA.
Yeah.
If you can tell us more about that, because your two
Yeah.
ETFs are actually amazing because they're large cap. One focuses on international and one focuses on the United States. And I want to learn more about those because, as you can see, we got so much things happening internationally. So I want to
Yeah.
see if that ETF is, because I know currently it's 20% year to date, but with all that's going on, is it benefiting or is it not benefiting the ETF? So tell us
Yeah.
more about your strategy and then the ETFs.
Yeah, sure. So we launched, we have two ETFs, BCUS, that's the Bancreek US Large Cap ETF, and then we have BCIL, which is the Bancreek International Large Cap ETF, which only focuses on developed markets. So it's no emerging markets within that. The strategy was born out of, and since we have a little bit more time, I'll kind of give you a little bit more of the backstory on it because I think that that's what really differentiates us. So
Yes, please.
um, back in the day, way back in the day, there was an organization by the name of Bell Labs, which I'm sure many people have heard of. This was where all of the communications theory and information theory was coming from that has enabled us to have this conversation over Zoom, right? And many other things, right? Among many other things. And so there was a gentleman there by the name of John Kelly. And John Kelly, I'm sure he did a bunch of stuff for Bell Labs, but in his free time, he also invented what had become known as the Kelly criterion, named after him, obviously. And this was basically a way to bet on a game where you were somewhat certain or knew that you had an edge on that game. So let's talk about things that you can't do anymore. Counting cards in Vegas, you can calculate exactly what your edge is. In fact, Ed Thorpe wrote a book on that called Beat the Dealer. Say you went to a horse race and it was fixed, back in the days of the mafia. You knew exactly, this was a formula to basically tell you exactly what to bet on that. And this was kind of talked about in detail if you love really cool stories about the mafia, about Vegas, and about math in a book called Fortune's Formula by William Poundstone. So highly recommend that book because it talks all about the Kelly theory and about Bell Labs and everything. Anyway, I had read this book back in business school circa 2008, was fascinated by it, but was like, this is cool. Don't know what to do with it. And then several years later, my best friend, Andrew Skadoff, who's the founder of the company of Bancreek, he read it and he's like, I bet this can be applied to equities. And so he went off and over 6 months, a year, figured out how to apply it to equity selection to help enhance equity selection. And his background is not in data science. His background is not in big data. And so he was doing it like, a very kind of with bubble gum and, chewing gum and duct tape type of way, but was able to do it in such a way to basically tell me when I was still working for doing all the pharmacy stuff that where I recreated it. And I was like, oh my gosh, he has something. Like this actually can be applied to figure out equities where we think there is a high probability or greater than 50% chance that they have edge prospectively, right? Not looking back, like going forward, we think that this company will outperform, right? So we started Bancreek in 2021. We spun out of a family fund or were supported by the family that Andrew left. We initially were only working with large families, helping to invest their money, and then eventually realized that we could automate the majority of the process. And that was Anton Yan, our chief data scientist, that figured that out. He had always told us, I believe I can automate this with like code that will just blow your mind, right? I mean, I have no clue what's going on within that code. Conceptually, I do, but could never recreate it. And so about midway through was like 2023, he's like, I have something. Like I have something that actually looks like it worked. And we looked at all the modeling and the back tests and we're like, this actually does consistently outperform us as humans. And so at that point in time, we realized that we could actually deliver a superior product for cheaper fees than we were doing like in the hedge fund style model. And we could also do it within the most tax efficient structure, which is an ETF. Like a quick aside on that, if your listeners or viewers don't know this, any quant strategy, which I would say like ours isn't a pure quant, but there's turnover, right? I mean, because at any point in time, we are using NATA, which is Anton backwards. We are using our system in order to select the top 30 companies that we consider have institutional endurance, which I'll explain that term. And so every net from like we're rebalancing it every month, right? And so company number 30 could go to 36 and 36 could go to 29. And so we're swapping things in and out. And if you're doing that within a mutual fund or in a taxable account, you're racking up gains, right? And then eventually you're passing those on to your client. In an ETF, that does not accrue that way. So we are able to the ETF allows us for the most pure application of our strategy of the best ideas that NATA has without subjecting our clients, the holder of the ETF, to any of the taxes. So like, I just caution people, if you're not looking at us, if anyone is selling you a quant strategy that's not in an ETF, you better look at the history of what people have paid in taxes and the distributions and stuff like that, because there's a fundamental conflict within that. So that's where the ETF came up. We launched our first ETF at the tail end of 2023. That was the US-based ETF. And then we launched the second one, the international ETF, in March of 2024. And so what is NATA actually doing? Well, it is taking, its basis was like grown out of the concepts of Kelly, which at its core is, how do I numerically score and identify what I think is edge within an equity? So edge obviously means I'm going to win more than I'm going to lose, right? So we tried a lot of different ways on how to apply this before we settled on one that really works. There's thousands of different time periods you can look over. Like, trust me, there was a huge kind of beta testing element within this. And then it doesn't work alone. Like, you need to, like, I like to tell people, it's like you can go and cook up a good piece of meat, that's Kelly, and it could be okay, but I mean, if you're not seasoning it with the right stuff, if you're not cooking it the right way on the right temperature and everything, you're just going to char the thing. And so that's what we found with this. It's like we had to, over time, figure out which were the features, the variables that the model wanted in order to maximize the risk-adjusted return of the billions of model scenarios that we were running to ultimately get comfortable that we could outperform prospectively, right? And so we ended up with a fairly complex model, a proprietary model that we call NATA, that continues to learn and grow every single month and iterate. It changes with the data, which is very important given that, things are not staying the same, right? And so it's changing, it's learning, it's growing and everything. But at the end of the day, what it's trying to identify are companies that, call it high quality companies, call it structural advantages. We like the term institutional endurance, which are companies that have growth, that have resilience, that have longevity, companies like that. But we're not doing it through a qualitative bottoms-up process. And this is where I think is really, really important for people to understand this. This is a long-term investing type of product, but we are using a quantitative engine to figure that out. And I'll give you an analogy, which I like. And this is the reason why I like the term endurance. So I wear this watch, right? And this watch measures my VO2 max. So it tells me like VO2 max is a great measure of my cardiovascular health, my endurance. It's not perfect, right? A lot of other things that you would want to know if I went in and actually did a stress test, like, an expensive stress test and everything. The bottoms up analysis is like sending me in and doing that stress test, right? Very, very expensive, time consuming, very painful, all that kind of stuff. And then the other negative side effect is you probably will get attached to this company that you've spent a month analyzing. And if all of a sudden it goes from being the number 28 company to number 35, you may not want to tell your portfolio manager to let it go, right? So that's some bias that we all have as people. What this watch does is it's the 80-20 rule. So it tells me what my cardiovascular endurance is by assessing that through a whole bunch of complex algorithms in a pretty accurate way, but not perfect. But it can do that like that, right? And so we've built effectively what is, I'd say, the VO2 max. That's what our tool is for stocks. So we can assess this level of endurance for thousands of stocks like that. And then we can take them and say, at any given moment, here's a top 30 in any investable universe. And so then it's just about what product, what exposure do you want? Do you want US exposure? Do you want international exposure? Those are the two that we launched. I wish we could spin up, 15 ETFs, but that's not the way this business works. Like you got to actually bring a good amount of money in to do it. So reach out to us if you want a Japan, a China, and emerging markets. We can do them all. And eventually over time, I envision this becoming a platform because we've studied it. And this process of identifying, applying the 80-20 rule to figure out what these high quality companies are rather than hiring teams and teams and teams of analysts. It really works. And it's, in fact, I'm kind of surprised that nobody's kind of worked their way into this before. It's not perfect, right? But that's the reason why we rebalance every month.
I
If
think
we
I
are
think
wrong on something, it kicks things out pretty quickly.
Yeah, like I think this is actually such a cool proprietary technology because, many ETFs, they might have their top 10 and it's usually the 10 juggernauts of the industry, or they'll have 400 companies and each of them are like 0.05%. So with this, when you're at the top 30, that pretty much covers various industries, probably top two, top three of each sector. And
Yep.
I think it's amazing. So, now that so the NOTNA system not only does it look at the quantitative, but does it also look at the macroeconomics, like what's going on in the world? Say there was some political turmoil. Will it take that into effect, or just the company's financial records and the company itself?
Yeah, so that's where I'm not saying that one day we won't eventually go there, but we are look initially we envision this as like an actively managed way to gain exposure to something that a client wants. So if you want US exposure, you've already made that decision. Here is an actively managed way that's highly differentiated. You can get that US exposure. If you want international exposure, here's a way that you can get that. Now, our CIO sits on top of all of this. And at the end of the day, like Natna spits out the names and we go through them. And because at the end of the day, I mean, we don't see future data, like, right? I wish we did, but we don't. And so we are still only as good as the historical data is. Now, it is proven to be highly predictive with the combination that we're using, but it doesn't always work. And so if there are ways that we can kind of dodge some bullets, we will do it. So I'll give you an example. I clearly know a lot about managed care, managed healthcare, right? I mean, we've already talked about this. Your listeners probably know. I'm sure we'll get back to it a little bit later. I think that is basically a ticking time bomb, right? I mean, there's a tremendous amount of arbitrage, there's spread pricing, there's contract games. Nobody really knows how the United Healths of the world make their money. It's a lot of smoke and mirrors type of stuff. And, the shooting kind of cascaded, this terrible negative sentiment within the space. And it just seems like the time has come to where this is not just a cash cow anymore. And there could be some very, very serious risks ahead. So, I raised my hand to the investment committee and I said, no managed care. I'm putting my foot down. Like, I do not want every managed care company that shows up in the top, get them out and then replace them with something else. And so we did that. And we dodged a few bullets in the process. Now, even if we hadn't done that, the tools are so responsive that what happens is after a couple months, they'll basically see the stock price action and then start getting a little sketched. They'll be like, okay, the market is telling me that there is some risk that's going on. I don't want to stick around to figure this out. So like, this is not value investing, right? I think everybody like thinks value investing is very sexy, but like typically when a stock is trading at value, it's because the analysts that are putting out those projections are just kind of like straight lining the numbers or expecting 5% up, 5% down. There's no imagination with this, right? I used to be an analyst, so I can criticize myself for this. They don't see major inflections in businesses up or down. And so you can get into a stock at 10, 15 times earnings and think you're buying a value stock. And then 3 years later, realize you bought it at 40 times earnings when the major inflection comes. It's a very dangerous game, in my mind. Whereas buying like long-term compounders that are fairly valued, that is the way to, in our mind, like that is the way that you can actually build long-term wealth. You have to worry about valuation though. We've found that valuation is important to consider. We're always looking at what should we do with valuation. Like we've included it as features, we've included it as kind of call it the bumper rails on a bowling alley to make sure it's
Mhm.
not too high, not too low. We've run, I mean, Anton has run like, I can't even tell you how many scenarios he's run on how to incorporate it in the best way because it's not as simple as you think. You can't just say the stock is expensive, therefore, I shouldn't own it, or the stock is cheap, therefore I should own it. There is almost no correlation between that. So finding where there is signal amongst the noise of that and amongst like the misinformation that we've all been trained in business school, like me, you have to kind of drop all that off. And before I let you talk again, that's the beauty of Anton. you know, Anton has no finance background, right? I have the finance background, the investing background. Andrew has, way more than enough for all three of us. But Anton's not polluted by all this stuff, right? He came from the depths of information theory,
He's
working for
unbiased.
he worked for Lawrence Livermore National Laboratory. So I mean, he was doing top secret stuff, launching satellites, like how do we communicate with Martians, like weird stuff like that, right? And so I mean, he was doing stuff that
He
was
goes
like
from hunting
essence.
aliens to hunting stocks.
Yeah, I know, right? I mean, talk about a step back, but I mean, he was fascinated by the idea of how do I take what I have unique expertise in and apply it to markets rather than applying it to, national defense or top secret work or anything. But he's doing the same stuff that, basically a PhD training in. He's just applying it to investing. But yes, does not have any of the bias that we all came in with because sometimes the bias serves you well until it doesn't. And so we really lean into the data and then just put those high level filters on top. I'd have to say that like normally we're focused at the sector level. There are certain sectors that do not tend to produce long-term compounders that we tend to avoid. There are other sectors that I think are, impaired, like managed care. But we also can, I have a very strong view on US markets and how risky they are right now. We have the ability to lean more conservative, right? We can change the variables a little bit within our mix and say, you know what, we think it's in the benefit of our investors to tilt a little bit more conservative to help reduce the volatility as we go into what could be very, very risky and dangerous times for the US economy.
Yeah, and you know what? Thank you for that because that leads me right to my next point about, for example, the CPI inflation and the non-farm payrolls. With America, tariffs this, maybe a war, who knows? But whatever it's happening, capital is being tied up at the moment. And not only that, but the rest of the country, including Canada, I might say, our job sector, hiring sector, employment sector, our inflation, all of that is actually wreaking havoc when it comes to the day-to-day purchases. I've been hearing eggs are what, $9 these days. Cabbage is like $5. So, can you tell us more? Because I know you have some
Yeah,
amazing data visualizations on the CPI inflation and the
yeah,
non-farm payrolls. Can you tell us more about that, please?
yeah. Oh, thank you. Yes, I'd love to. I'm not sure if you have the ability to bring up these things on screen while we're
I
talking, but
definitely will. Yeah.
okay. Oh, sweet. Okay, so yeah, so as I said earlier, I'm a data nerd. And so what before we launched our ETFs, I I never wanted, I loved creating data visualizations. I did this a lot for CSX. I mean, when I created 46 Brooklyn, I published data visualizations free to the public to try to explain this. Like, I'm a very, very big believer and I'm very passionate that people should not be trusting the media right now to interpret anything for them, right? Especially when we have so much data and so many tools and we have Google and AI that can tell you how to do everything. You just need to have the initiative to go do it yourself. Right. And so I'm like, okay, but that's a lot of work, right? And I do have a fairly unique background. Let me make this a little bit easier for people to do. And so I was doing that at 46 Brooklyn. I was doing that for our private clients just because I couldn't let it go. Like, I mean, if you give me a data set and there is a complex data set, I'm going to put it in Tableau and I'm going to try to create like some visual art out of it to help better explain, to help better educate, right? That's what it's all about. It's about education. And then ultimately that education leads to better decision making, for investors, at least within this business. It should. So when we were launching the ETF, we have to bring up it's the first time we have a public presence, so we're looking to create an advisory site. And so I started looking at all the advisory sites, and it's just basically like a bunch of platitudes. Not meaning to criticize my competitors, but like it's a lot of stuff. I'm like, we're unique, blah blah blah, And I'm like, okay, fine, you got to do a little bit of that, but I want to repurpose our site to just do macroeconomic research and data visualizations. And basically, to give something like if my main goal is to just how do I add value to the investment community, I think maybe I'm biased, but I think you think, Jacob, that our ETFs probably add value. It looks like their performance, they add value, they're very unique. They probably will resonate with some people. But let's say you're like, I don't do that. Like I'm just a macro trader. I want to add value. I don't have a way to charge you for it. So why not just give it away for free, right? I started creating these data visualizations. I started with CPI. I moved to PCE when I started getting some feedback of like CPI is all well and good, but Jerome Powell's looking at PCE. I'm like, you're right. So I figured out how to do PCE, and then I moved to employment. I have a couple other dashboards, but the three main ones are the two bubble charts that are PCE and CPI, and then the jobs database or jobs dashboard. So I think these are critical for people to use if you want to arm yourself for what is going to happen. Like, and I haven't, I know I'm biased, but like I haven't said this strongly with this much conviction really until just lately. So, I mean, Jerome Powell just talked today. I didn't read all of it. I didn't pay attention to all of it, but so much of it was focused on tariffs, right? So much on tariffs, inflation, what's going to happen? We're not going to raise. That is that's smoke and mirrors. And you don't need me to tell you that. Just pull up my dashboard and then look at the bubbles. There are bubbles on the left-hand side and bubbles on the right-hand side. The ones on the left-hand side, left hand, those are the ones that are inflating. There's about 180 different items that the BLS categorizes. So the ones on the left-hand side are inflating at over 2%, the Fed's target. The ones on the right-hand side are inflating at less than 2% or deflating. And this is on a year-over-year basis. The size of the bubble is the weighted inflation. The unweighted inflation doesn't matter, right? I mean, yeah, you mentioned eggs. I can pull this up right now. So if you go to blog and you go to visualization, the visualization tab, and then you scroll down to the CPIU visualizer, and then you look down, you'll see this big bubble, not super big, but it says eggs and it's dark red. Well, dark red corresponds to the unweighted inflation, which was 41.5% in May, according to the tool. When you hover over it, it shows you the entire historical trend, so you can see exactly where it is. I'm a big believer in looking at the average, the standard deviation. So you have the 1 standard deviation band, you have the 2 standard deviation band, because we have to be aware of like which are the more volatile items. Something could be going up by 6%, is not a big deal if it's with plus or minus 1 standard deviation. That's just normal volatility for that item. Eggs is well outside of the normal volatility, but the prior year relative importance, that's code word for weight, is 0.12%. So if you had $100 in your bank account, you spend $0.12, 12 cents, whatever that is, on eggs. So does it matter? I mean, yeah, for people that buy a lot of eggs, it is, if all you're eating is eggs, but does it matter for CPI? No, it does not matter for CPI. Right now, the inflation impact, the weighted inflation it added 5 basis points. So 0.05% of all CPI was eggs. So then I don't need to tell you this. Data's here, right? Go through and just start hovering. Tick through all of them. And then just come up with it. Like, what do you think is going to be impacted by tariffs? Televisions, computers, iPhones, like, I don't know, Costco stuff, like, like a whole bunch of crap that we consume that we buy from China. And then look at this and look at the weights of the items. What's the biggest bubble by far in here? Owner's equivalent rents of residences is 26.7% of the entire CPI measure. That is a survey-based proxy for what you could get if you decided, hypothetically speaking, to rent out your property that you own based on someone that calls you. I think it's once every 6 months. So it's not even a real number. It's totally an artificially manufactured number. That is 27% of all of CPI. Well, then rents are another 7%. Motor vehicle insurance is another 3%. Electricity is another 2.4. Full service meals and snacks is another 2.45. Gasoline is 3.65. You start going through all these numbers and you add them up and you're like, I just did this math, by the way, in my latest report. If people pull it up and read it, it's free.
Yep, I'll have everything on the in the
Yeah.
description
Oh,
box.
sweet. Thank
And
you so much. Yeah.
yeah, and I'll also have it up on the visuals. But so I think this visualization definitely needs to go viral because this will put all the people who are complaining about eggs to to stop
Cut it
talking about
out.
eggs.
Cut it out.
Um,
Cut it out.
because
It
that
doesn't matter.
yeah, no,
If
that is
I
actually so cool because I'm gonna definitely like in deep look into it because by looking at what is affected by inflation, you can actually, as you said, right, look at making good or not so good decisions based on your purchasing history. And so I know everybody's talking about a recession, a recession, a recession. So based on your visualizations, where are we in the recession timeline? Is it like what
yeah.
is 25? Now that 25 is coming to an end in the next six
Yeah.
months or so, 6 months at the end of 2025, 6 months in the beginning of 2026, what do you think is going to happen?
Yeah. So I am not concerned about inflation. And that's so like, but okay, let me restate that. I am not concerned about CPI or PCE. We have 330 million perspectives on inflation in this country. We all have a different share of wallet for different products. And some people are going to be crushed by this inflation relative to tariffs, right? Or related to it. PCE and CPI. And again, read my writing, the latest one that I put out there. I don't want to regurgitate all of it here. But when you actually work with this data, there are such forces within OER and rents that they actually can offset meaningful tariff inflation over the next 6 months, 6 to 8 months. So I actually don't worry about it at all over the next 6 to 8 months just because of how distorted these benchmarks have become that are driving, our perception or the Fed's perception of inflation and thereby the market's perception, right? So that I don't worry about. I disagree with Powell because that's what he's saying that he worries about, but he's not looking at my visualizations apparently.
He
Uh,
should.
which is a little shocking because he should really, I mean, they should all know this, that like this is so distorted. Now, maybe they think this is going to transfer over to the housing market, but we're coming off a huge surge post-COVID. And
Yep.
there's just cycling issues. I mean, the cool thing about this data is once you look at it, you can actually project inflation pretty well over the next couple months. Like my projections that I put out have been pretty accurate. Um, Largely because nothing really changes abruptly outside of like events like COVID. And so cycling of prior year weirdness tends to drive what the year over year number is going to be. So anyway, based on my projections, don't worry about this. Jobs is very, very concerning for me. And so why is this the case? The beauty of this is like I have no specific edge on anything in the jobs market besides that I use my own tool, which is again free to the public, free to everybody. So go in, use the tool that will be in the show notes. Hopefully, you're showing it on the screen, and then come up with your own opinions on it. But here's what I see. So when I look at May 2025 and I look at the current jobs report, when you pull up this, you'll see the default. It immediately shows you at display level 3. So think of this as a hierarchy or like levels within a mine, and you're going down to lower and lower levels. This is within the BLS's data. So the highest level, if you go to display level 0, is total non-farm, the 139,000 jobs that we got. When you go to display level 1, you go to private service providing. Display level 2 is private education and health services, leisure and hospitality. That's typically where people stop. It doesn't really help me, right? But the great thing about this data is it goes to level 3, it goes to level 4, and then not for the latest month, but if we kind of go back 1 month to April, you can go all the way down to level 7, where you can look at full service restaurants, capacitor, resistor, coil, transformer, other inducer, electronic connector, and other electric component manufacturing, in case you were curious about the number of jobs there and how that's changed since the beginning of 1990. I mean, like, this is a treasure trove of data. And I put together a heat map, right? Or I'm sorry, a tree map of this. So basically what it is blocks of data that's grouped by subsector. So if I'm looking at this level 7, Then I see the professional and business services subsector, and within that is administrative management, general management, consulting services, and then you'll see everything collected there. And the ones that are most green had the highest number of job ads over that period. The ones that are most red had the most number of job losses over that period. And the really cool thing is that you can actually change the period. So if you want to go back and look over the last 20 years, you can do that. And you can see that over the last 20 years at a level 3 display level, healthcare and social assistance has added 8.5 million jobs. By far and away higher. Second place to that is professional, scientific, and technical services, which is where all the jobs related to AI and people working at Google and Apple and everything. That's 3.849. So that is, I mean, pales in comparison to what's happened in healthcare. What I've been walking around with, and my main talking point, has been over the last 2 years, and you can switch this to 2 years. Healthcare has added 1.91 million jobs. Overall, total private job ads have just been 3 million. And so we've had 63% of all the job ads over the last 2 years have come from healthcare and social assistance. So that's only 17% of all of our employees, by the way. So, 17% of the bucket has created 63% of all the job growth. What if I
Wow.
took those out? Like just take healthcare out, say, you know what? What if it went to zero? We only added about 40,000 jobs per month over the last 2 years. We are,
Wow.
we basically are a recessionary, from a job perspective, we are a recessionary economy without healthcare. Okay. Now, before this one big beautiful bill came up, I would have told you this problem will keep going and going and going and going and going until the whole thing spectacularly collapses because all of a sudden we have like a $5 trillion deficit sometime in the future and everybody just loses faith in the US economy. I don't know when it's going to happen, though. That's a very long-term call. This one big, beautiful bill has pulled all of that forward, right? Because now we have a situation where we're like, okay, we really want to extend these tax cuts. How are we going to pay for it? Well, if you've spent any time just perusing the budget for the federal government, there's really nowhere else to cut money besides healthcare, right? I mean, unless you want to start talking about defense, probably not going to happen, right? So overall, I think it's something like $2 trillion that are spent on Medicare and Medicaid altogether. Then you have the ACA subsidies on top of that. I mean, like it's like, a lot of money that's spent per year on Medicare and Medicaid. And as you asked this question earlier on, the expansion of Medicaid, the addition of Medicare Part D, and the lack of the government's ability to manage all of that and the outsourcing of it to the private industries, which created all the middlemen that everybody hates now, that's created the just consistent upward growth in jobs and the consistent, upward costs that is now approaching $2 trillion for all these federal programs. Well, all of a sudden we are saying we want to cut that. We're going to cut 1 trillion off of that within the next 10 years. And so you're talking about, I don't know, the numbers like a 12, 13% cut like that
Wow.
to Medicaid. And so, there's 109 million people on Medicaid and CHIP right now. And so I know there's a lot of discussion about like the human toll that this is gonna take of people that right now have healthcare that will not, and like what is going to happen to them. And it's very, very sad. That unfortunately doesn't seem to be driving the discussion, or having any legs. What I think should is the 20 plus million people that work in this industry that, if we all of a sudden say, hey, you know what? We're going to stop contributing about, 12% of what we were. We're just going to lop it off.
Do you think,
How
do you
can that
think,
keep going up, right? How can that
yes.
keep going up?
So if it's always going up and it's obviously something that the government wants to, or the Fed wants to cut or trim, other sectors all have a bubble of some sort. There's a housing bubble, debt bubble, student loan bubble. Does healthcare have a bubble? Meaning, I know it's a essential service, it's a very sensitive sector, but can healthcare pop? Like if it has too much debt or if something happens?
Uh, I don't think so. And the reason why is because healthcare there's no like self-correcting mechanism like there was in 2008, where the industry, where like basically the markets can take care of this problem. I mean, I'm sure United's not so happy about its stock going down 50%. So like maybe that's like the beginning of the end there, or the beginning of some changes there. But in large part, what's happened is that layers and layers of complexity have been layered on top. More and more middlemen have been formed. More and more jobs have been created. More and more money has been extracted from the system in order to enrich people, to create jobs and everything. And the federal government and the state governments have been basically saying, okay, we'll foot the bill, you know? And how does that break? I mean, it only breaks when at some point in time, people all wake up and they're like, I'm not refinancing your debt anymore, US. Like, this is unsustainable, right? I mean, that is my worst case scenario, that I would love someone to contact me and try to talk me out of, like, how nobody's been able to tell me how this doesn't happen. you know, and so maybe you can. I know, Jacob, you talk to a lot of people, you may have to be pushed back and I'll change my mind, right? I mean, but what I'm concerned about is that this bill gets passed largely as is. I mean, the Senate made it even worse, as far as the impact to healthcare. The healthcare situation needs to be fixed. It's very, I mean, from a human being, a morality, side of things. But there are so many jobs. It has been the economic growth engine of this country for the better part of 20, 30 years. If you all of a sudden rip that Band-Aid off, what the federal government is trying to tell us right now is that if we make these tax cuts permanent, we're going to have an abundance of growth. Well, where was the abundance of growth over the last 4 years, when we had all these tax cuts, or even longer than that, right? There wasn't any. It was healthcare. Healthcare was the growth. I had 40,000 extra jobs a month outside of healthcare. Professional and business services isn't growing. AI is only going to hurt that, right? As it displaces more and more jobs. So where are the jobs coming from outside of healthcare? Government was helping. Clearly, that's not going to help anymore. And so we're being sold, or the market has basically become this frog in a boiling water, complacent, that if we get this through and we avoid a war and the tariffs get scaled back and the Fed starts cutting because Eric said inflation is not a problem, then this is great, free money time, party time, let's speculate on everything again. Well, this will take time to happen, right? But as things get phased in, as the Medicaid cuts get phased in, as cuts to Medicare gets phased in, as the ACA subsidies go away completely and 22 million people lose their health insurance, as those things happen over time, as 300 plus rural hospitals close, that are literally the lifeblood and economic lifeblood of their communities. And then you have the knock-on effects of all the restaurants that close and everything. As all that starts happening,
it's just a ripple effect. Everything just starts getting affected.
It is, yeah. I mean, like, the second biggest growth driver of jobs has been restaurants. That's a second derivative thing, though. They're not growing on their own. If people have extra money to spend, they'll go buy stuff at Chipotle or whatever, or go out to meal. But I mean, like, if I have to scale back, I'm probably not eating out as much. So that's what I get concerned about. So inflation not a problem. Fed starts cutting. Let's say tariffs aren't even that big of a problem. No one knows what's happening with them right now anyway. Let's say you can even see them within the data, but the jobs numbers are teetering. Fed starts cutting. Everybody's excited. And then all of a sudden, the healthcare ball drops. And the jobs start going down. And the Fed keeps cutting. And the jobs keep going down. Because the dirty little secret that nobody wants to talk about is the Federal Reserve's interest rate policy, monetary policy, has no impact on healthcare jobs. Medicaid reimbursements, Medicare reimbursements, government spending. This is what is the lifeblood of healthcare spending, right? I mean, I shouldn't say no. I mean, on the fringes, it will. Like, will there be more private equity firms that want to, like, bring AI to, like, healthcare startups? Sure. But that's not where all the money is. That's not where all the jobs are, right? All the jobs are in hospitals and pharmacies and the administrators, the many layers of administrators all throughout. And then once there will be, I shouldn't say there will, there could be a day where at some point in time, people realize the Fed does not have the tools to fix the job market anymore. And I do not want to be like, I hope I'm wrong. In that world, if that all comes to pass, it will be a nasty, that's the bubble that pops, right? Once people realize the Fed can't control this.
Yeah, and I think that's actually the most interesting statistic that I have heard in a very, very long time, where healthcare is the main industry. So when they're saying we're growing, no, 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 it's one sector that is holding everything together. It's like the
Yep.
glue. And if that one sector is trimmed, cut, or somehow sinks, it's going to have the most catastrophic ripple effect, especially as you said, right? In the restaurant
Yep.
industry is the top three industries that are hiring. So if we don't have enough nurses, they're going to be unemployed. They're not going to go out to eat. It's going to have everything pretty much just unraveling. And
Yeah.
yeah, like truthfully, that is such a statistic that I have never heard of. But you know what? It totally makes sense because I haven't met a person in medicine that was never without a job, but I've seen, scientists, professors, those sectors, may or may not have a job. Um, I think this statistic definitely needs to get out there, and I'm just so happy that you're on my channel talking about it because I am definitely going to be advocating for this because I don't know how it is in Canada, but this is now something I'm going to start looking into Canada as well and see, hey, are we being propped up by one or two sectors? Because 50 years ago, 100 years ago, not even 50, 100 years ago, the main industry was, of course, automation, the Industrial Revolution, and so on. And we've obviously moved on from there to, the tech boom in the early 2000s, mid 2000s. But now healthcare seems to be the one, kind of carrying everybody on their back. And
That's it.
so, what do you think about healthcare and technology? Do you think technology is also playing a factor in maybe taking jobs away that other people used to do?
Um, that's hard to say. I think that there has been a lot of very early on in the AI days, which was like only 2 years ago, I feel like. There was a lot of concern because, like, on the private side of our business, like we had some healthcare calls and investments and everything, and there were a lot of concerns that AI was just going to automate a lot of the stuff away, like doctor diagnoses and everything. And it was like, no, it's not happening. I mean, if you talk to any physician, what are they doing? They're going to a program called Up to Date. And that you're presenting with certain disease state or this or that, or you come in with a cough and this, blah, they're going to plug all that into Up to Date. And there are literally humans on the other side that, physicians that are populating this database with the latest research and everything. And then the company that owns that, which happens to be a holding within BCIL, by the way, BCIL, it's an international company. The company that holds it has that data. It's private data. It's its property. So it can put AI on top of that, but it's not public information. Well, now you go out and it's like, I don't even know how AI has learned as much as it has, but it's unbelievable. And now, I mean, I think I am out of my area of expertise to even speculate on what AI could do or technology could do to healthcare. Um, I probably will be wrong with whatever my kind of speculation is because it seems to have completely outperformed any of my expectations so far. I know it was pretty bad when it came to healthcare and some of like, diagnosing disease states, asking about the nuances of drug pricing. It didn't know a thing, and it has gotten considerably better, despite the fact that most of that information lives behind paywalls. So I don't quite understand how it's gotten so great. But there is infinite money, at Google and Apple and everything. So they're probably buying access to all of it anyway.
Oh,
So
definitely.
I kind of dodged your question because I'm not an
It's a
expert
hard
to.
question,
Yeah,
and
it's very, very hard.
it
Yeah.
is, especially now in the early days. Like I would say we're pretty much in the emerging era of AI,
Yeah.
kind of like the 1999 tech boom Y2K. We didn't really know what the internet was going to be used for until we're like, whoa, videos, whoa, music. And then, we just thought it was for email. I did see one thing where AI was very beneficial in healthcare was I think it was X-rays and AI imaging, where they was able to go really, really deep into the human body and find, certain illnesses. But still staying on the AI topic and maybe even blockchain, what do you think about cryptocurrency? I know, 10 years ago, 15 years ago, even 5 years ago, institutions were not even trying to get into it. But last year, with the spot, Bitcoin spot ETF. Institutions are all over it now. Do you think Bancreek or even yourself, what are your thoughts on crypto, maybe a crypto ETF coming down the line?
So this is an easy answer to that. I have no view on crypto. Bancreek will not be getting involved in crypto. Like we have an area of expertise that we think we are highly differentiated when it comes to public equities. We do see applications of NOTNA and the Kelly-inspired framework to some private assets, which I won't mention at this point in time because I don't want anyone taking our ideas. But there are
Definitely
some
keep it secret.
applications. There are some applications that are possible, but are down the road. But we have not spent any time looking at how do you construct, a crypto basket using any of this. It could work. More power to somebody that actually tries to employ this, but that is just not what we're focused on. I think that I can assure you, if you talk to me 10 years from now, we will not be there. There are
No,
people that
and
are doing that really, really well. I mean, one of my really good friends is like, that's all he spends his time on. And, for me, it would be speculating. I don't like speculating. I like investing. For him, Bitcoin is investing because he has an edge on it. He knows so much about it. And so, like, I think it's the knowledge, the edge. Like, we have an edge in what we do. He has an edge in what he does. So I let him stick to that and we'll stick to what we know.
okay, good because I've talked to so many people and they're kind of the same, half and half. Half are like, we're thinking about it, we're looking into it, and then the other half is like, nope, you can ask me in 10 years, 20 years, 30 years, I'm still not going to touch crypto. It's kind of like what Warren Buffett said, I think, rest in peace, before he passed away. He said that if you gave me $1 million in, say, for example, property, he would rather take that than $10 billion in Bitcoin because he knows that the property is a tangible, actual asset. He never believes in crypto. I don't know what Munger's ideas are these days, but I know they were not the crypto people. So back to your ETF. I know your ETF, both ETFs, they have this amazing strategy that you use to pick your top 30 companies. And so it's kind of like moving away from traditional investing. 10 years
Mhm.
ago, you had the split, right? 20% bonds, 30% treasuries, and you had that little pie chart that everybody always showed off. But with the strategy that you have, would you consider this to be a form of traditional investing, or is it traditional investing kicked up a notch? And who are these ETFs for? Are they, because I know you said it's a long-term horizon. So of course, I'm thinking someone who has maybe 10, 15, 20 years of time. But who are these ETFs for?
Yeah. Um, I think it's just it's an evolved way of investing. I think ETFs are an evolution from mutual funds. And this quant engine with this kind of like qualitative, like call it like we're the principal, right? It's like we're just monitoring to make sure everyone's behaving, not us behaving. This quant heavy focus that helps identify prospective edge. I think that is kind of long-term fundamentals investing evolved. I mean, you look at people like the gold standard of investing is having teams of analysts that know like what the CEO ate for breakfast that morning. And it's just like I think that people have a hard time with, we all want certainty in life in a very uncertain world. We can't have certainty, and so we try to like fill that void with knowledge. And then we think like if you build like a DCF model, discounted cash flow model with more lines or more years, that is going to give you a better edge on that stock. But in reality, it's just flooding it with more details that are hiding the uncertainty of that we just don't know. Right. So, I mean, we don't have to worry about that with what we're doing. We are relying on these like extensively tested and developed tools to continue to find companies that have these structural advantages. And here's where I'm going to say something a little controversial. Like everyone says, past performance doesn't indicate future performance. I'm not allowed to say that's not true, right? That is a true thing. if you're looking directly at a stock or a mutual fund or whatever. But I've worked in many companies, as I told you in my background. And so I understand the inner workings of what is my long-term incentive program? What is my strategy? What's the management bench look like? What's my competitive positioning? What's my pricing strategy? All of these things take years and years and years to build and execute, and you build these competitive moats around them. And so if I lived inside these companies as a consultant, I could tell you which ones I would invest in and which ones I wouldn't invest in, right? And so if you can identify these fundamental traits of businesses that can continue to compound cash using this 80/20 rule, using this heart rate monitor, then you can cover so much ground. And you don't have to be right all the time. You just have to be responsive when you are wrong. That's what we've created. That's why I think this is investing in evolved. This is not just for people that want a 10-year outlook. This is not a volatile product at all, right? We're not using leverage. You don't have to lock your capital up. We are looking at win rates going back, maybe not month to month. We don't care too much about that, but certainly yearly win rates. We're looking at those when we're evaluating models. We're looking at 2-year, we're looking at 3-year, we're looking at all rolling periods. I mean, we're looking at our volatility. Our products have, and I mean, I'm not sure if this is true as of today, but I looked at it about a week, 2 weeks ago. They've achieved, especially BCIL, the international, which we can talk about a little bit more and why that's done so well. But that's outperformed its benchmark and the S&P 500 by 20 percentage points or something like that, with lower volatility, with only 30 stocks. And so we're turning this whole concept on its head. About people have criticized us where they're like, how can I only invest in 30 companies? International, that's far too concentrated. I'm like, yeah, but we're like pretty much equal weighted, right? And look at our diversification. Huge industry diversification.
And they're tried tested
Huge.
companies. They're not small companies. They
Yeah,
have a proven track record.
yeah,
Yeah, let's stay on the topic of BSIL. Can you tell us more about the international companies that it holds, and
yeah.
the current effect that it has?
Yeah, so I'll talk about the companies a little bit. Again, like I want to preface this by I talk about the companies that I'm most comfortable talking about. I would highly advise people to not go out and just talk about the companies that I'm talking about. This is not a single stock selection. We have never tested this product on here's the 6 stocks that Eric likes, that really are cool to talk about. Just buy those six stocks and then do billions of back tests. We don't have any tests, so I can't tell you that strategy is going to work. What I can tell you that we have a lot of confidence in is BSIL itself, which is a collection of 30. When you put all 30 together, it works. Having said that, I know everyone likes to talk about stocks, so we can talk about that a little bit. So there's a variety of names in here. The first one that I will point out, because I've been a long-term holder of it personally, it has been held on our private side. It is arguably one of the best performing companies in the world over the past 20 to 30 years, and it is in your backyard, Jacob. It's in Canada. It is a company called Constellation Software, which most people in the investment world in Canada, it's like the guy that founded it, Mark Leonard, is a legend. He's like Warren Buffett status within Canada, except he never does public interviews. You'll almost find nothing of him talking to anybody besides his there are pilgrimages to see him when he talks once a year at the annual meetings and everything. The guy is a genius on the private equity side of things, and he's figured out how to execute a private equity model in a public, wrapper effectively. And he does it all through vertical market software. So think about like mission critical software systems. The best example, which everybody knows and gets, is like if you've got into a bowling alley, which I'm sure most people have, and you interact with that software, like how fun would bowling be if you had to go back to paper and pencil, right? That is an example of mission critical software. There's mission critical software in every industry on this planet, right? Stuff that absolutely has to be used in order to run the business operations on a day-to-day basis, and they buy companies that are 5 million, 10 million, 15 million. They're getting larger, but they buy lots of small companies that are highly profitable, very, very low capital intensity. So they're spitting out tons and tons of cash, and they plug them into their portfolio. And they're basically a holding company, a highly diversified, holding company that lets these companies operate within their ecosystem, learning from each other. And they have created a culture that has pushed down the acquisition responsibility down to the lowest level. So, if we bought your company, Jacob, then very soon after that, you may be responsible for acquiring another company and then building like a little mini enterprise within Constellation. This is how they have been able to expand and continue to maintain 20 to 30% growth annually for the better part of 30 years. So the amount of compounding that they have done is insane. And it checks all the boxes on things that we look for: longevity, durability, growth. It's off the charts on our quantitative system. Natna loves it, has always loved it. It gets a little pricey sometimes, but with a company that's doing a lot of acquisition, carries a lot of goodwill, price to earnings almost is meaningless for them. So you really have to look at EV to EBITDA, and then it becomes a little bit more reasonable, but it's not as much of a hidden gem as it was before. Not surprisingly, Natna's finding other companies that rhymes with Constellation. It's looking for companies that have low capital intensity. It's looking for companies that have been able to sustain this growth by producing a lot of cash and investing in high ROE opportunities, whether that's inorganic or organic growth. I talked about UpToDate, that if you go to a physician in the US, or probably a lot of other countries, the system that they turn to figure out what you have is probably UpToDate, mission critical software for the hospital, for that physician. That's owned by Wolters Kluwer. They support accounting, they support legal, they support environmental, they do a whole bunch of stuff. Relics is another example of a company that does almost the exact same thing. They are like a sister, they're not a sister company, but they're very, very closely related if you look across their product offerings to Wolters Kluwer. So all three of those sort of rhyme. We own a company called Baycurrent, which is, think of it as a hybrid between McKinsey and Accenture in Japan. And so they are like the preeminent Japanese consulting company that is benefiting from the technology revolution, that is helping companies understand how to bring their business to the next level within Japan, which has been one of our top performers of the year. We own Dollarama, which is benefiting hugely from everything that's going on in the US. So, the dollar store's misery here with everything that's going on between US and China trade tensions is the benefit of their Canadian competitors. And so Dollarama is done very, very well and has a completely different outlook there. There's other companies that are very random, like ASICS, that has come into the portfolio recently.
The shoe company?
Yeah, the shoe
Oh,
company. And so, I mean, I can't tell you why the tool loves ASICS, but the tool loves ASICS at this moment. It
and
may
it's
not
doing
love it.
well, right?
It's doing very well. I can't tell you that it's going to love it 5 months from now, but the amount of time that we have spent understanding the inner workings of it has given us confidence to just kind of rely on it unless it starts highlighting. Like, for example, it used to say it loved Novartis. It loved Eli Lilly on the US side. And we said, no, 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 we don't like that. And so we got rid of pharma before the whole obesity thing kind of, because it doesn't know the dynamics of the healthcare system. Healthcare is very complicated. There are a lot of things going on. We're able to dodge that because of a lot of the knowledge that I have. But for things like, shoes, I'm not going to push back against that. If the tool likes it, we're going to go
Yeah,
with it until it doesn't, And you'll look across those names and you'll start, like the company that owns Zara, the discount clothing retailer.
yeah.
It's in the portfolio, just made it in recently. So once I saw that, I was like, oh my gosh, it's it's stuff that is just totally random, highly diversified, all over the world, going from these high tech holding companies to running shoes. So and none of them have anything to do with it. This is why BCIL is my favorite product. It's because it's the most random collection of cats and dogs that you could ever think of.
And you
The
know
only
what? I'm
they
definitely
have
going to be buying some BCIL because I am like as you're talking, it's totally interesting me because it's not human picking the stock based on what their interpretation is.
no.
It's a very, very intelligent technology that is picking not only based on fundamentals, but also foreseeing what can it do down the line. I think this is actually so cool. And my viewers, definitely check it out because this is going to be breaking some waves.
Yeah, yeah, we actually own, one of the cool ones was BAE. So This is like the largest European defense contractor that has gotten huge run up because of everything that's gone on with like all the infighting with Trump and countries like Germany saying like we have to start spending more on our defense budget if we're going to become more friendly with Russia, so on and so forth. The tool identified that before all that happened. So I mean, I'm not saying that it's prospectively gonna. It's not designed to identify inflections in things. It doesn't see the future, but that has been a very high performing company for a very long time. It had the structural kind of components that we were looking for, and the data identified it. And it just so happened that we were sitting in it when it had this boost that it's had.
That is
And then
actually so amazing.
we haven't talked about and I don't know if you want to get into this, but like, what do you do if you even like remotely believe that my views on the worst case scenario can come to pass for the US if we have like this rate cutting inflationary environment eventually because of the rate cutting, but then no job growth because of healthcare. And so you have stagflation, you have
Yeah, can you
further
talk about that
decline.
correlation?
Yeah, so I mean, like if you start having all of this now, again, inflation is going to be heavily weighed down by what's going on with the housing market. So we may never see any meaningful inflation due to the tariffs. But if we start cutting rates and there's speculation that starts going on, that could start lifting the housing market again, right? And then all of a sudden we could start seeing very, very, very high inflation pretty quickly, right? Well, not pretty quickly, it's lagging, but that could come within the next couple of years, right? At the same time, if the Fed starts cutting and we kind of believe in this whole jobs thesis that I have based on healthcare and the concern in healthcare, and we can't spur healthcare job growth because we have not reversed the cuts to healthcare and Medicaid and Medicare, and we've gone double down on that, whatever it is, then you end up with a situation where people have lost confidence in the Fed. They no longer have control over the dual mandate. They have control over part of it. They don't have control over the second part of it without creating a tremendous amount of inflation. What happens then? Now, I'm not an economist, right? I don't know what happens to rates. Doesn't seem like it's good for them. I don't know what happens to our interest rate that we're paying on debt. Doesn't seem like people are going to want to hold our debt. I don't know what happens to the dollar, but seems like it's probably going to go down a lot, and get a lot weaker. And then all of the knock-on effects of that, especially if you start having a kind of a contagion effect around that. Well, the beauty of this kind of like recession, if we call it that, or this like challenge for the US that don't really know how we get around, is that it seems, again, I don't know, but it seems like this is less global contagion than, say, 2008, where like all of this was carved up and held by all sorts of European banks and blah, 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 mortgage-backed securities. From what I know, we're not carving up medical debt, and like, Germany's not holding a whole bunch of like subprime medical debt right now. Like, so, so long that that is true, so long that that is true, then this is a unique American kind of the ending of American exceptionalism type of situation. And then if tariffs even have any effect, you have the strengthening of trade partnerships between Canada and Europe, and then Europe and China, and strengthening China, a weakening dollar. All of this pushes towards you need to have more international exposure. If you could say, I don't even want money in equities at all, but where are you going to put them, right? I mean, international equities they seem prime. They underperformed for so many years, and they are trading at such an extreme discount right now. I mean, last I looked, they were trading at a 7-turn discount, like 14 times earnings, compared to like 21 times earnings for the S&P. And this is unbelievable for me with how negative my outlook is for the US and how positive the outlook is for everywhere else, right? All of the developed countries and emerging markets, which we don't play in yet, but hopefully we will
Do you
soon.
think this is kind of like the beginning of the end of the superpower? Because looking at it historically, whenever you have a superpower that is high in debt, they're not exporting much, they're pretty much importing everything. When that kind of happens, that's the other country that is the one exporting everything. For example, China, they're on the rise. I think it was
Yep,
what was his name when he did the new Ray Dalio. So Ray
yep,
Dalio talked about this, the economic cycles and the fall of the superpower. What are your thoughts on that? Do you think this is
yep,
the beginning of America's downfall?
yep, yeah. I mean, like, I just look at the math. I can't figure out how you grow your way out of this without healthcare. And then if healthcare does grow, you need to make it even more inefficient, which will then basically continue the disproportionate growth trajectory of the expenses that we're paying. I mean, I don't want to go too far out on a limb with this statement, but like, look, I mean, so don't quote me out of context. The context is the rest of our interview, right?
Don't worry, I'm not
Like,
CNN.
but we have to immense success operated a unique business model within this country. And it has been one that has been reliant and on being able to come up with any idea and start a business literally overnight. I mean, it's a beautiful thing for entrepreneurs. That's why they all come here, right? I mean, there are almost no barriers to just like making your dream come true, right? But then when you make your dream come true, right, and you're a billionaire, there's every way to avoid paying taxes on
The
that.
collapse of America. And my next point was, what is the solution to this? Do you think, I know it might be disastrous, but destroy everything and start from the ground up, or are we
Yeah,
still able to change things while the old system is still going on? What are your, like, what is this? Is there even a solution until there's a collapse? Because I think personally, and just from my experience, everything that we know now, especially after COVID, is being propped up by printed
yeah,
money.
yeah, yeah,
It's
yeah.
not genuine dollars. Um, is there even a solution?
Yeah, I mean, no, no. Um,
And that's
I'm
unfortunate
not smart enough.
because
I'm not smart enough to figure it out. Like I could say, like in some fairy tale world, I do think there are solutions to get healthcare moving in the right direction, to reduce efficiency, to without eliminating jobs at least overnight. I think there are ways, like I think we have to pay more taxes. Like, I mean, the math is just what it is. Like, I don't
you
know
kind of pushed against
how.
the wall. You kind of have
Yeah,
no
I mean, like, what are you going
choice.
to do? Like, I mean, like, you
Yeah.
don't need to spend much time looking at CBO numbers or the government. Like, the numbers are what they are. And so, I think the best kind of most optimistic outlook is that we can keep doing this forever because people will just keep, our credit score as a country can be, like, I don't know, what would it be? Like, if we were, it would be like 20, right? But yet
Exactly.
we're getting credit access like we're an 830 credit score,
I
right?
know.
And so we can keep doing that for years and years and years and years and years and years. And that is the most optimistic argument. And I couldn't argue against that because it's already been so long that we've done that. That like, why would you call, like, it's not an investable thesis to say that's going to end tomorrow or next month or whatever. But I mean, I do think that there needed to be another catalyst, and I think that the policy that could be coming down the pike that could end the healthcare stuff, which the intentions are good to eliminate a lot of the inefficiencies within healthcare, but the unintended consequence of that could be surfacing this kind of the ugly kind of underbelly of what's going on to be like, oh, wait a second, wait, they cut interest rates, no one's paying, or people aren't paying taxes, they're not paying their fair share. Medicaid, the demand for Medicare is exploding, but people aren't getting this health care. Jobs are being eliminated. Where are the jobs at a zero interest rate environment? That is going to be a very, very scary proposition, I think,
It's
if that
going to
comes.
be very scary. And that's the one thing that a lot of my viewers keep asking me is, how will this affect the market? How will this affect stocks? How will this affect companies? Because we've seen from COVID that COVID destroyed millions of brick and mortar stores, businesses, and that was a major change. And
Yeah,
if this unfortunately does happen, then it's not just stores and retail, but this is life and death. This is going to be health. This is going to be
yeah,
employment. This is going to be, of course, the national debt and, of course, personal debt. And so, if someone in this crazy climate that we're in, with the stock market, if someone were to start, their investing journey, of course, BCIL should be the first one you buy. But if they were just starting their investing journey, you said stay away from healthcare. What should they do, not only in the companies that they choose, but the approach that they should take when investing,
yeah.
especially in this crazy market that we're in right now?
I think that, look, you need to, you listen to me, drone on and on about this. These are my own personal views. I really think that the first thing you need to do is basically, stop looking at your social media, stop looking at your news feed, stop looking at other people's interpretation that algorithms are telling you. And I'm not going to drone on and on about how that's turning us to zombies and everything. I just think it is providing you with bad information. It's not investable at all, right? What is investable is your own analysis of data. So I have analyzed my own data. I have analyzed it. I've tried to provide it to you. There's so much more that can be done with this. You can take this to the nth degree with all sorts of different databases that are in the public domain and do it while they're still there, right? Until they get removed. And then come up with your own views. I mean, I don't think, we know a lot about the economy already, how this generally functions. Bring your curiosity to this journey. Here is what happened with healthcare. How could this impact things? Like, I start thinking about, my brother-in-law is a dentist, right? Well, he's a dentist in a very wealthy suburb of Charlotte. Well, people that are in the wealthy suburbs of Charlotte, and this is a side that will make sense, trust me, in the wealthy suburbs of Charlotte take good care of their teeth. And so, as a dentist who gets paid, basically, you eat what you kill, like you get paid basically a percentage of the revenue as a dentist, especially a young one. You're not going to make very much money if you're cleaning people's teeth and, filling a cavity every now and again. You need the root canals, you need the implants, you need all the nasty stuff. And so what does he do? He works 40 miles out west in the sticks in a high Medicaid facility where people have not had the privilege that people have had of wealth and don't have the resources to health, and their teeth are in much worse shape. And so what happens when we start eliminating Medicaid? That not only impacts the people who won't be able to take care of their teeth, so their teeth just fall out and they don't get replaced, but it impacts my brother-in-law, who now doesn't have a job there, has to go into suburban Chicago, work at a more expensive place, and potentially move to a less expensive place. And like, the cascading effects of all of this will just blow your mind. But it all starts with the data and then bringing your curiosity to think about this. Like, I'm not an economist. I'm just a really curious person that knows how to work with data. And I think if we all were, then you can come up with your own view and I can respect your view. Like, if you were like, man, I'm all in on healthcare, and you talk to me about that based on data, I'd be like, I love it. Like, I'm all about that, right? I'm all in on international right now because of what we've talked about, right? I think if you're going to be positioned in equities, if you want to have exposure to foreign currencies, I mean, international has a huge leg up on the US at this point in time. And if you are exposed to the US, you better sharpen your pencil and really pick stocks, right? And that's what we'll be doing. And because we'll we'll learn, and it will grow over time. It will become better and better in the US markets. We, from a top-down perspective, will look within it to say, like, are there any areas that other subsectors that we need to remove completely that are going to get disrupted as the information comes in. So, we are very excited about because as well, but it doesn't have those natural long-term tailwinds that the international has right now. But again, it starts with the data. Please use the tools. They're free. We're going to keep them free. If you go out and you support us by buying our ETFs, if you like the story, that can ensure that these are free for a long period of time. And I spend a lot of my time doing this research, talking to people like you, putting out these free tools. The business rationale behind that is to get exposure to the Bancreek brand, that we are doing something. We have a unique, investing philosophy, but then we also just in general want to support the investing process and want to educate people to make better decisions, even if that's on their own. Like, we feel very, very strongly about it, and it put our money literally where our mouth is by giving these tools away for free. So use them, build better versions of them. Reach out to me. You want to start getting into, like, how do you work in SQL to actually start building these databases, stitching them together. I'd be happy to help you with it. Frankly, nobody does. It's frustrating to me because I feel like if more of us were in the weeds, not only would it be more rewarding rather than just reading all this kind of, all this like manufactured kind of like secondhand
Mumbo jumbo.
reporting. Yeah, yeah, not knowing what to believe. But it also would it would make us all better prepared.
And I think
Have conviction curves.
And thank you for creating this data and the technology, because I think the number one problem or issue in investing or even in just life is people not being educated in what they're trying to do, right? Like for example, people, if you're trying to cook, you're going to obviously take out a recipe. If you're trying to invest, don't listen to your neighbor, right? Actually look at the data, look at the information, because men lie, women lie, numbers don't. So if you look at the numbers, you can see a pattern, you can see a growth of whatever you're trying to look for. So I personally am definitely going to be utilizing your data that you have created, the technology you have created, and I'm sure many of my viewers are looking at this like, wait, there's an actual shortcut of knowledge. So you've already done all the heavy work, and so now it's just time for the regular average investor or even the professional investor to actually start looking at the numbers. So Eric, we're not done yet, but you gave us some amazing wisdom with healthcare, AI, NOTNA, the strategies, like uncomparable. Thank you for the knowledge and wisdom. But also on this channel, whenever I get to interview someone, we have a little segment where I ask you three out of the box questions,
I love it.
nothing to do with finance. Are you up for it?
Yeah, yeah, this is fun. I love it.
Okay, perfect. So if Bancreek was a person, what kind of personality would it have?
That's an easy one. We would be Claude Shannon. So Claude Shannon was basically the father of information theory. And so I don't know, I've never met him. He died long before I was born. But well, I shouldn't say that. But like I never had the opportunity to meet him. So I only read stories about him. He was very, very smart. He was doing revolutionary things. He was pretty nerdy. He clearly liked to work with data. He liked to invent things that are outside the box. And he liked to have fun. Like, I mean, Claude Shannon was an avid investor as well. And he used a lot of what he learned in order to actually become a pretty successful investor. That was passed down to John Kelly. That was passed down to Ed Thorpe. So Ed Thorpe is a legendary options investor who used the Kelly framework to, before it was widely known, he used Kelly to actually, figure out how to bet on counting cards. But then he eventually took Kelly to options before, options was even like really a thing. And so he was actually doing the true arbitrage and figuring out how to bet on that. So we would be one of those guys kind of trolling around with like the pocket protector and like the thick, black horn rim glasses and everything at Bell Labs back in the 60s. That's who we'd be.
I still remember that Simpsons episode where the nerds were getting picked on, and they look back at Nelson and say, before you know it, nerds will rule the earth. So I think we're here at that time where the nerds are creating everything, innovating, and making those big moves. Okay, second question. What is the most random app that you either currently have now or have downloaded on your phone or your device? The most random app. It could be like a
Oh, okay.
meditation app, if anything.
Well, I was actually gonna give you that because it is pretty random. So, okay. I mean, I'm like pretty hooked on Audible, so that's not random
Oh,
though. So I'm not going to
nice.
give you that one. I'm like a really big sci-fi fantasy fan, so like I'm on this one series right now that I spend all my free time streaming. So, I'd say the most random app is one called Simple Timer.
Oh.
It is the most bare bones. So like I have a little bit of like an OCD type of, you probably could tell from how I'm talking throughout this interview, but all the meditation apps have like, here's your streak and like, congratulations. And like, they have the notifications, you haven't meditated yet. And it turns it into like another thing to
A
check off.
chore, yeah.
And like, that defeats the purpose for meditation, right? I mean, I've studied it long enough where, and practiced it long enough where I don't want to make it into another, check thing on my checklist. So the simple timer one, like literally all it has is a timer and a bell, nothing else. And it's free and it, I don't track how long I've done anything and there's nobody watching me or anything. And it seems to work for me right now.
It's pretty much you making the rules, the schedule, the everything. It's just a simple
Yep.
timer. It's not a chore. It's not like, oh, I gotta get up and do my meditation. It's more like, hey, I have some time. Let me, clock in.
Yeah,
Um,
that's it. That's all it
Okay,
is.
so last question. If you were not in finance at all or engineering, what unrelated career or path would you have taken?
Teaching,
Ooh.
100%. Education. I feel I haven't closed the book on that. I haven't closed the door on that. I taught last a year ago. Yeah, it was a year ago. It's just ending right now. I taught at my son's high school. I actually created a course called the Carbon Economy, and
Ooh.
co-taught it with this amazing person, who was another instructor, 30 years of experience. And so she kind of helped me translate a lot of the stuff that I was trying to do. But it was like a college level course that we taught at the high school level on as an elective, and it was trying to kind of get into the science of climate change, to basically be like, this is not a political thing. Like, this is just like literally a chemical reaction. And then after that, be like, but you know, there's a much broader discussion. Like, same with healthcare, same with the economy, same with investing. Like, there's no like right or wrong, black or white, any of it. Like, there's this entire kind of like discussion that needs to be had around, like, look at your quality of life, my quality of life right now. Like, this all was built on the back of oil. And so we can vilify oil as much as we want, but I don't want to know what the world looks like if we decided to leave all of it in the ground. Like, I mean, it would have looked, you know, like we were in the late 1800s. And like, that is not a life that I want to live right now. And so, and, it also went into the fact that we were living in Nigeria right now. An entire year, we would consume the amount of energy that an American consumes in 2 to 3 days. And so is that fair? I mean, should we vilify other countries for wanting to drill and wanting to have access to cheap, transportable oil? Like, honestly, like, I used to work at Exxon. They said, like, it's the most, if God could invent a molecule, it would be the oil molecule to like transport energy. It's the perfect molecule, like, right? I mean, it can get no better than that as far as energy efficiency goes. And so, I mean, we just have this problem with CO2 now. So, so I mean, it went into all of these things, and then it went into the economy, the economic ramifications of all of a sudden trying to flip the switch, and how do you pay for it? And it really got the students thinking bigger picture about how I need to be educated when I come to a debate, not just be like, I'm a Democrat, I'm a Republican. You have to see both sides of the story, and you have to be willing to empathize with the other person across they have a family, like the CEO of these oil companies, they have families. They just want the best for their families too. And so it really dug into that pretty deeply. I don't know how successful I was, but like, I would love to be an adjunct somewhere at a university locally here. I would love to get more into teaching, as I get older, and hopefully as BCIL works and everything, and hopefully as all your viewers, if this goes viral and all your viewers have recreated the free databases that I give them and no one needs me anymore, then I can drift off into the sunset and just start teaching.
I'm
That's
sure
my
you'll
dream.
be getting a whole bunch of messages very soon asking you so many questions about building data visualizations. But I think, hey, being a professor, teaching, in my personal opinion, is a wonderful career. Lifelong learner. You're, passing knowledge down to the next generation. Maybe want to stay away from the little ones who are crying and you got to wipe boogers and things like that.
Oh,
But
I'm not good at
yeah,
that.
me neither. But I would love to, same as you, I would love to teach at the high school, college, university level. I think that's where like real deep learning comes in. Anything younger than that, you're pretty much just babysitting.
Yeah, that's right. That's right. Yeah.
Okay, Eric. So this was an amazing, amazing interview. Where do you see Bancreek in the next 5 years or so? I know you guys are long term, you're ahead of the game, you have your amazing technology, not nah. Is there maybe another ETF maybe coming down the line, or maybe something happening? What's
Yeah, I
what's going
mean,
on for Bancreek for the next 5 years?
so I'll try to keep this short, but it's a long answer, but I'll try to keep it short. Um, when we got involved in the ETFs, like, we always were, and this didn't work for us early on. We always just wanted to create products that we loved and had conviction in. And in some cases, like before we got into the ETF business, like, we realized after the fact that there wasn't demand within the market for it. And we're like, whoops, like, we're just different, in what we wanted. And so, we brought these products to market that not only do we love, and that's why we brought them to market. And we think they're value added, they're differentiated, but we think that there actually is a home for them, and there is demand. But the ETF industry, for those that aren't familiar with it, it is highly consolidated, nearly impossible to break in as an independent, company, bootstrapped, like we were, with, four people that are just trying to make this work, right? It's very, very hard to get distribution, like almost impossible, So you can bring the best idea to market, and like anyone can go buy us, right? You can buy it on Schwab, you can buy it on Fidelity, you can buy it on E-Trade, you can buy like really any platform. We're traded on New York Stock Exchange. You can go and buy it. But if you have, X amount of money and it's with Morgan Stanley or it's with Merrill Lynch or it's with Goldman Sachs or anything, there are all sorts of hoops that you have to jump through in order to get distribution on their platform. And then to actually get their marketing team to basically even give you the time of day, right? And so it is just a very, very long-term process to kind of build it brick by brick, to talk to people like you, to get the word out. I mean, like the retail side is so fascinating to me because I feel like what we're doing will resonate with retail investors who, really are interested in an advanced way of investing, but don't want to have to do all the work themselves and want to do it with very low fees. So I think the retail side is really interesting, but like retail won't pick up until we have like a viral moment, right? And there are a lot of like firms like us that are out there without these really long discussions that are gonna tell you why they're like the next greatest thing since sliced bread. So really what our focus is right now, like Anton is just constantly innovating, innovating, innovating. Yes, we're always looking at new things. I would love to have an emerging markets. I would love a China only with my outlook on China. All of these things are in the hopper. I'm not saying that like there's any stage that they're actually going to come to market. We don't have anything that's even close, but we're always evaluating new industries. But let's be real, like you have to bring an ETF to market and know that you can get to 30 to 50 million dollars pretty quickly. Otherwise, you're going to lose money on it as someone like us that has to outsource it and you have a lot of expenses. So we need to have that distribution side. Man, the retail market could help us a ton, and so, to the extent that people like what we're doing and you have these smaller investors that come in and like what we're doing, fantastic, that can help. But that's like the masses, right? I mean, you get a lot of $100 investors, it can add up quickly, but you got to get a lot. The institutional side of the money or the advisor side of the money, I mean, those are much, much bigger checks. Like if you get on a platform, you could be looking at 20, 30, 40, 50, $100 million, but you're not going to get on that platform until you have much longer track record than we do, until you're much larger, until you've, hit all the hurdles, like everything that they kind of arbitrarily want you to do, they just won't let you on. So it's like a game of Tetris. It's a puzzle that we're trying to figure out on how do you get the word out? How do you build the retail side? How do you get distribution? And how do you do it on a shoestring budget? Because we don't have the budget to hire like a big PR staff. We don't have the budget to hire like a huge, marketing team or anything like that right now. And so it's just about being like, hey, we said the entrepreneurs are the great American heroes. Like that's what we're doing. We're just trying to put something out there that we love, we believe in, and we have confidence that will work, but I can't tell you how it's going to. I just know it will. And so
Well,
5 years from now, it will have worked.
well, the best part is these days, most people get their investing opinions and advice from social media. So as long as you're doing these runs, talking to people like me, you're on who have a social media platform, I think you will definitely, definitely get to wherever you need to get to, whether it's Bancreek, whether it's another investing firm. Because the last time I watched MSNBC or even Bloomberg was a year maybe, because everything
Yeah.
is just readily available. Like you might see a Bloomberg clip on social media rather than tuning into the Bloomberg channel. So I think when it comes to you're absolutely right. Us retail investors, we might put in $100 compared to an institution that might put in millions of dollars. So
Yeah.
I'll make sure that I'll round up my audience members to start putting in those $100.
Well, I appreciate that. And,
Every
and
bit
hey,
helps.
I
Um,
mean, there's also tons and tons of hurdles as far as like, obviously we stay right in smack in the middle of the marketing rules, regulations, everything. They're very strict for exchange traded funds. And so there's only so much that we can say. So, but when you publish this, you can go out and do whatever you want. I have to send it to my compliance department. It'll take them about a week and a half to turn it around. We'll have all sorts of disclaimers and everything on it after the fact. So there's very little that we can do on social media organically. So it's kind of a difficult business challenge, like strategy challenge on like everyone's living on social media, but you can't really go out there and actively talk to those people and
That
interact
is
with.
true.
And so this is really like the greatest opportunity for me is to have these long form discussions with someone like you that has better idea of how to navigate all this. And then, people can listen to me or think I'm a fool and then
No,
make
not at all. And you know what, Eric, you are always invited on this channel at any time. If you
appreciate
bring
that.
out a new ETF, if you just have some new healthcare information or even something about your visualized data, I will always be open to host you. And Eric, honestly, I think we've been interviewing for more than an hour and a half. You have
Mhm.
given us so much amazing information and wisdom that I learned so much from you today. And I'm sure many of my viewers have as well, especially with your technology, especially with the statistic about the healthcare, pretty much the glue to the whole economy, society as a whole. Next time I see, something about the payroll or CPI on television, I'll say go nurses, because they're the ones. The medical team is the medical field is the one holding it all together. So Eric, thank you so much for being on my channel today. You have just blown our minds. And my viewers, this is not the only time you will see Eric on this channel or talking about Bancreek. But remember, check out the two ETFs. All the information will be in the description box. And remember, you can always DM message Eric about anything that he's talked about today. I'm sure he'll be open to helping out because I know I'll be asking him questions. Eric, if there's any other last mentions that you would like to, put out there into the digital world.
Yeah, I just say like, check out our stuff online. I know Jacob, that's the greatest advertisement that we could have ever gotten. So I really appreciate that. But just know that, when CPI is released, when PCE is released, when jobs are released, and everybody's talking about these, like, it went up this much and down this much, and this is good and this is bad. About 15 to 30 minutes after the release, my dashboard is published. And you can make your own judgments on what's good or what's bad. I can't write the whole thing in 15 to 30 minutes, but I really don't even think you need to read what I'm writing if you spend a little bit of time working with these, and you will be so much smarter than anyone else writing about like these high level aggregated numbers, averages, all these things that don't really mean a hill of beans. You will be so much better prepared than them just by, better access to the data. And to get the word out that this is available, and to just think that like we could be educating people even if they say no to the ETF. I mean, as an educator at heart, it means the world to me. So, I mean, I thank you so much for this time, Jacob. I will come on anytime you want. You just tell me the time and place and I'll be there.
Definitely no, and the same to you, Eric. Viewers, please make sure you like, subscribe. All the information is in the description box. So until the next time, stay ranting.